Good afternoon and welcome to today's Trust and Estates webinar, Life Insurance Trusts, an Insider's Guide to Minimizing Liability and Maximizing Client Value. This webinar is sponsored by Life Insurance Trust Company, an affiliate of ITM 21st Company. I'm Susan Lipp, Editor-in-Chief of Trust and Estates, and I'll be your moderator today. In a moment, I'll be turning things over to our speakers. But first, let me explain how you can get the most out of this event. To improve your viewing and listening experience, you could move your webcast windows around by dragging on the title bar or resize them by clicking on their lower right corner. At the bottom of your screen, you'll find multiple application widgets. There are 2 resources available for download in the green Resource List widget. We welcome questions about our topic and will answer as many as we can following the presentation. But feel free to submit yours to the queue at any time. Just type it into the Q&A window on the left-hand side of your screen and hit the Submit button. If you have any technical questions, you may ask them there as well. And as I said, we will try to get to as many as we can, and those that we can't get to, we'll be sending to the presenters to answer you at some future point. For attorneys getting CLE credits, please listen for a code word that will be stated at some point during the webinar. To get your credit, you'll need to put that code word into the survey that appears at the end of the webinar. You can open the survey now by clicking on the survey widget on your screen. This webcast has been applied for and is pending approval for 1 CE credit hour towards the AEP designation program, the CFP Board CE credit hour, and the Investments and Wealth Institute. Please be aware that today's session is being recorded and will be available for on-demand viewing. You'll be notified by email when the archive is available. Now, let me introduce today's presenters. First, we have John Barkhurst, who is Senior New Business Development Manager. John oversees new business development and account management for ITM 21st Trust Services Division and has been providing third-party administration and risk management solutions for trust-owned life insurance since 2004. Next, we have Leon Wessels, Corporate Business Development Manager. In his role at Life Insurance Trust Company, Leon is responsible for new business development and managing strategic relationships. Next up, we have Judith Pearson, a seasoned insurance industry and risk management expert who leads Woodruff Sawyer's family office and trust liability practice. Next is Michael Brohan, who is principal at Your Life Insurance Solution. Michael, along with 2 partners, started Insurance Trust Monitor in 2007, now called ITM 21st. It's the largest manager of enforced life insurance policies in the country. And then finally, we have Tony McKillop, Senior Trust Officer for Life Insurance Trust Company. In this role, Tony oversees all aspects of management, administration, and compliance of the trust company's operations. You can find more information about our speakers by clicking on the Speaker Bio widget at the bottom of your screen. So with that, let's get started, and I am turning the floor over to John.
Thank you, Susan. Welcome, everyone, and thank you for attending today's session on life insurance trust. It's certainly a privilege to present to such a prestigious group of estate planning professionals, and we want to say a special thanks to Trust and Estates Magazine and wealthmanagement.com for the opportunity to share some insights on a topic that we're very passionate about. Here at ITM 21st, we were pioneers in providing ILIT management systems, policy review services, processes, and best practices to help corporate trustees better manage their trust-owned life insurance holdings. We've certainly learned a lot over the last 2 decades, but nothing compares to the experience that we gained when we began providing complete ILIT administrative outsourcing services in 2007. In this model, we assume administrative and risk management responsibilities while acting as agent for the corporate or professional trustee. And this experience and expertise is what ultimately paved the way for the formation of our own trust company in 2017. Life Insurance Trust Company is the industry's only corporate fiduciary focused exclusively on this unique asset. Our speaker panel today, as Susan introduced, is really a group of industry experts and thought leaders in the life insurance trust space, and we're excited to share our insights with you in the next few minutes. Before we begin, I do want to mention that rather than making the slide deck available, we've created a handbook to accompany today's presentation, and you can find that handbook under the Downloadable Resources tab if you'd like to reference it now or at any point during the session or in follow-up. So with that, why are we here today? What are the learning objectives? Well, why have over 1,000 estate planning attorneys and advisors chosen to dedicate 1 hour of their busy schedule this week to tune into this unique topic, life insurance? We know from experience that ILITs are not a desirable subject. In fact, life insurance is usually the least favorite of trust-held assets. But with that said, irrevocable life insurance trusts have long been a cornerstone of many estate plans and still remain a great tool for creating liquidity upon the death of a grantor. So in the hour session to follow, we'll discuss the following topics: trustee roles, responsibilities, and personal liability, the challenges facing trustees and how to manage TOLI risk, how low interest rates negatively affect life insurance and why we can expect it to get worse, practical solutions for dealing with TOLI policy issues, and why an individual non-corporate trustee may not be ideal for long-term client success. We should have some time, as Susan said, to answer some questions, so please get those in. And of course, if we don't get to all of them, we will follow up with you directly. So there's a reason why life insurance typically falls to the bottom of the list for most wealth advisors. It's a peculiar financial instrument that requires specialized knowledge and expertise to properly manage. And there's no denying the fact that management of life insurance has become increasingly more difficult in recent years. In the last 2 decades here at ITM 21st, we've analyzed over 50,000 unique trust-owned life insurance policies and have conducted hundreds of thousands of annual policy reviews for over 200 institutional trustees. This experience has given us a unique ability to see and be part of trends in the TOLI industry. It's provided great insight into why life insurance presents so many challenges for trustees, but more importantly, how to manage TOLI risk. A few key statistics and trends are worth highlighting at the onset of this presentation. The first is current insured's age. Like society in general, the population of TOLI insureds is aging. The greatest jump in age groups in the last decade by far was the 80 to 90 and the 90 plus categories. And insureds over the age of 60 make up approximately 72% of all insureds. Life insurance costs generally increase with age, and policy management decisions will no doubt only become more difficult as clients get older. The second is policy duration. 61% of policies are over 10 years old, including 28% of policies which are over 20 years old. Policies are issued based on current assumptions at the time, and over the last couple of decades, performance and policy funding rarely has followed the patterns found in the original sales illustrations. As policies age, the issues around them tend to increase. The third is trust duration. The average age of an ILIT is 20 years. However, the average duration is 35 years. This means that a trustee is responsible for 3 to 4 decades of trust and policy management. What could possibly go wrong in a 40-year time span? Of course, the short answer is a lot. And to illustrate this point, consider this. 34% of all policies reviewed are rated high risk, meaning there is a high probability they will never pay a death benefit. Later in this hour, Michael will dig a little deeper into the specific issues affecting life insurance today, but more importantly, provide some practical solutions for dealing with TOLI policy issues. It's important to note that many of the policy issues and the overall failure rates that we see at ITM 21st are primarily TOLI with a corporate trustee, that being a bank or a trust company with the assumed expertise and experience to manage the complexities of life insurance. However, it's estimated that today, approximately 90% of all trust-owned life insurance is represented by an individual trustee. While this may be a professional, such as an attorney or a CPA, most likely the fiduciary is a non-professional individual, that being a friend or a family member or business associate of the grantor. And in a few minutes, Tony will talk a little bit more about why an individual ILIT trustee is probably not ideal for long-term client success. It's a growing trend and represents a significantly higher percentage than we saw 20 years ago. At that time, most banks were willing to serve as an ILIT fiduciary. The corporate ILIT trustee landscape has changed dramatically in recent years, and trust banks are realizing there's very little upside to serving as ILIT trustee. This has resulted in a greater emphasis on the involvement by the grantor's attorney and other advisors. So at this time, Judith is going to join the discussion as we examine more broadly the challenges trustees and wealth advisors face with respect to personal liability and fiduciary risk. Judith?
Thank you, John. And I appreciate the opportunity to participate on today's webinar. Considering the historic amount of wealth being transferred over the next 25 years, some say upwards of $68 trillion, combined with the current financial crisis and market volatility, trustees are being placed in a difficult position. With the enormous amount of wealth accumulation also came significant use of trusts, a shift in assets held in trust from marketable securities to alternative asset classes, such as businesses, art, cryptocurrency, and of course, life insurance. Finally, while there is significant legal structure and a body of law created by litigation, many of the laws are new and untested. This creates personal liability for trustees. Trust laws and structures are changing and are complex and contradictory. There's a movement from traditional or delegated trusts to directed trusts. This is evidenced by trust companies in South Dakota alone growing to more than 100 administrative trust companies over the last 20 years. In the directed trust environment, the trustee duties are bifurcated and the number of fiduciary and non-fiduciary positions available are growing. As of January 2020, 35 states have adopted the Uniform Trust Act, all with slightly different language, and at last look, 17 states have adopted domestic asset protection laws as well. Given this evolution, we need to pay attention to the complexities and lack of test cases. There's currently the Ed and Marie Borsage Texas divorce case, where the allegation is that Ed Borsage hid marital assets in a South Dakota trust, which is currently testing the privacy and asset protection laws. This illuminates the interplay between state, federal, and international laws, which will continue to be tested. Another example is a past tax case between South Dakota and Missouri. The good news is the structure held up. However, what happens if there's a slightly different fact pattern or different state involvement? That is still an unknown. With all of these changes, what is expected of a trustee? I will not go into detail at this time, as you will hear from the ITM 21st and LITCO speakers later on, and in more detail about the roles and responsibilities of a trustee. However, know that the responsibilities are enormous and ever-changing. More importantly, you may have been asked to accept the role because of your expertise and relationship with the grantor. However, there are always additional skill sets to learn. An example may be a lawyer who expertly drafts the documents but may not have the full expertise to understand the accounting issues and vice versa. And of course, you will hear in great detail the expertise needed to manage a trust-owned life insurance policy. I encourage every trustee to seek out resources to help them do the job correctly. There are accounting resources, training resources, and of course, life insurance management resources. Please reach out to all of us if you need some suggestions. There are evolving market standards. Trust companies have increasing aversion to risk. As a trustee, be intentional and pay attention to the documents. A recent client appointed a trust company as trustee for his special needs son. While the grantor was alive, he wanted a non-fiduciary position that would allow him minimal oversight and limit his trustee risk. When I reviewed the documents, most of the risk had been shifted to my client. After discussion with the appropriate parties, the lawyers in the trust company were able to rewrite some of the clauses to ensure the original intent. There are new roles to consider. It seems like trust protector is currently the most overused term. The origin was an administrative non-fiduciary role, but is being expanded either in the documents or in execution. In the documents, we see the role as more extensive than simply hiring and firing trustees and changing situs, such as oversight roles. I have a number of clients who, in an effort to do the job well, are requesting reports and participating in meetings, which could create additional obligation and legal accountability. A further new trend we have seen is beneficiary advocate, which are there to protect the beneficiaries and hold the trustees accountable. This will be an interesting trend to watch. Finally, almost all regulatory boards are reevaluating fiduciary standards. Don't think for a minute that these standards don't apply to trustees because they're created for another professional. I don't know how many of you noticed Trump 2 weeks ago declaring that ESG investment principles are not appropriate for 401ks. Not a week later, on October 1, I saw an article on Bloomberg that Mary Ann Tsao, vice chair of the Singapore-based Tsao Foundation, said she faces tough choices. Her fourth-generation family office adopted sustainable investing principles, but with the global economy affecting investments, relatives are suggesting to return to new ways. All of this is to say, understand the roles and responsibilities you have as trustee, be intentional on the execution of your duties, identify and understand your risk, find ways to mitigate your risk, such as resources like ITM 21st and LITCO. Finally, knowing you can transfer some or all of the remaining risk through insurance. That insurance is called trustee liability. So what does it cover? Trustee liability is a type of professional liability insurance, also known as errors and omissions, which is similar to directors and officers and professional liability coverage available to institutions. Pay attention to the structures of the trust assets, as there can be exclusionary or administrative language that dictate coverage. Make sure all of the roles and responsibilities are covered. As an example, family advisor is not a trustee, so it needs to be added. Review the way payment for defense costs are administered, especially when there are allegations of gross negligence and intentional misconduct. If you are a professional working for a professional service organization like a law firm or CPA, examine the corporate trust policy. I am told time and time again the corporate policy covers the person as a trustee. There may be standard exclusions that apply, such as you need to be serving in your professional capacity. I've never had clarity on how that works in the insurance policy, and it may not cover you when you serve on corporate boards such as LLCs that are frequently used in the directed trust environment, and non-fiduciary roles may not be covered. More importantly, if you work for a large law firm, there may be a large deductible. It is not uncommon for a large international law firm to have a $1 million deductible. I would love to be a fly on the wall during a management committee meeting where a partner is requesting reimbursement for a $1 million deductible. I am often asked who pays for the insurance. It depends on the state and the trust documents. Be specific when incorporating the ability to have the trust assets pay for the insurance. I have one client in California where a judge interpreted that language to apply only to property and general liability, not trustee liability insurance. Granted, this was a highly adversarial case. However, be specific. State the ability to purchase trustee liability insurance with trust assets. I have clients that invoice the trust directly and others that increase the fee to cover the expense. Professional trustees often will allocate the premium over all the trusts. I hope that gives you a good overview, and feel free to ask any questions. And with that, please welcome back John Barkhurst.
Thanks, Judith. Certainly no shortage of challenges facing trustees and advisors today, and especially the case when you throw life insurance into the mix. So let's take a look at that, more specifically. Life insurance is complex and often misunderstood. And unfortunately, the risk of mismanagement can result in substantial liability. Typically, when we think of TOLI risk specifically, we're dealing with three main types of risk. The legal risk is usually what comes to mind first. Who's getting sued and why? Later on in the hour, Michael will touch on some litigation and disputes that have arisen in recent years as it relates to life insurance trust and policy mismanagement. The second is regulatory risk. This may not be relevant to individual trustees, but corporate trustees must comply with standards of care laid out by the Office of the Comptroller of Currency and other regulatory bodies that provide oversight. And lastly is reputational risk, which of course is of critical importance for any professional trustee, wealth advisor, and their firms. The idea of managing TOLI risk is easier said than done, but luckily there is some guidance available for ILIT trustees. The first of three guides that I'll point out to help fiduciaries with trust-owned life insurance is the Uniform Prudent Investor Act. The trust document itself may, in fact, override the UPIA, but if not, it must be followed. And not every aspect of the Act is applicable for TOLI, but there is enough guidance to make it a framework for prudent TOLI management. So of the 16 sections that comprise the UPIA, 7 sections provide guidance for TOLI trustees. Sections 1, 2, 4, 5, 7, 8, and 9 are all applicable to life insurance, and I would encourage you to review them. Section 9 is of particular importance, and I'll highlight it. It refers to the delegation of investment and management functions if the trustee does not have the necessary skills to manage the asset. Know that there are cost-effective life insurance trust administration solutions that you can shift those duties, responsibilities, and liability. The second useful guide is the Unique and Hard-to-Value Assets Handbook. Now, this handbook was published by the Office of the Comptroller of the Currency in 2012 to provide guidance for national examinations of trust banks. However, it does provide some great useful insight for all TOLI trustees, corporate and individuals alike. The handbook includes a dedicated section specifically for life insurance and provides some guidelines and recommendations for TOLI trustees. And last is our very own TOLI handbook. It was written by Michael Brohan with the help from other ITM 21st staff. It's a compilation really of our expertise and experience in managing this difficult asset. This handbook is utilized by all members of our trust services team, and we're pleased to make it available as a free resource to the industry as well. So with that, I can't think of a better way to introduce Michael Brohan into the discussion. And as was mentioned earlier, Michael really is instrumental in the creation of Insurance Trust Monitor and many of the processes utilized to this day in managing hundreds of issues that arise weekly on over 15,000 policies at ITM 21st currently. He's got some great insight into the specific challenges facing TOLI trustees today, and will offer some practical solutions for dealing with policy issues. But before we do that, I think Susan is going to jump back in and provide the CLE code word.
Yes, thanks, John. For all of you who are attorneys wanting to get CLE credits, the code word is fiduciary. So make sure that you put the code word into the survey at the end. It will ask you for it. Again, the code word is fiduciary. And so now I will turn things back over to Michael.
Thank you very much, and that's a great code word for this particular session. As Judy pointed out, we live in a time of evolution, and there's 4 significant challenges that we're looking at right now with life insurance trusts. The first is policy performance, and we're going to discuss the reason, what we can expect going forward, and how to deal with it. The other issues are really complementary, and they're policy complexity, consumer expectations that are growing, and also litigation and disputes, which are also growing. The most significant effect of the current pandemic on life insurance is the continuation of the historically low interest rates. Life insurance, actually the entire insurance industry, is negatively affected by low rates because insurance carriers must invest the bulk of their money in fixed vehicles. Since 2009, we've seen the Federal Reserve hold interest rates down. We saw a bit of an uptick in rates, but now rates are almost to zero. And let's be clear, these are the lowest rates in the history of the world. And we can see the effect, for example, on whole life dividends, which have been sliding actually for the last 30 years. A large portion of their investments is in high-grade bonds, so the performance of Moody's AAA Corporate Bond Index is often used as a proxy. Dividends will run a bit higher than the index because they include profits gained from the carriers of their operations, but dividends will typically track along with the index. And the chart on your screen tracks whole life dividends against the Moody's index, which currently stands at or near its lowest point ever. And the spread between the index and dividend rates now is wider than it's been at almost point in history. And that begs the question, what about the future? So how many of you out there believe that interest rates will be going up anytime soon? The Federal Reserve has already said they'll be staying the course, and many believe we could see rates near zero for up to 5 years. And the insurance carriers agree. In the last few months, several carriers have reported expectations of their future rates, some dropping their expectations dramatically. One from 3.25% down to 2.25%, one from 4.25% to 2.75%. I can tell you this, expected returns below 3% do not bode well for the carriers. And there's another issue out there. Carriers profit on some policies from the interest rate spread, which is the difference between what they earn and the amount they credit to a policy. And in this environment, that spread has been constricted. So if a carrier is required to credit a policy 4%, and as we just noted, some are expecting to only earn 2 to 3%, what do you think is going to happen? Well, one of the things all of the carriers on your screen did was raise the cost of insurance in their policies. And those cost increases doubled and tripled the carrying costs on policies overnight, causing many long-term policyholders to abandon their policies because of the rising costs. And as John mentioned before, many trust-owned life insurance insureds are older and can't get new policies. So if we assume rates will remain low, we can assume that additional increases could be coming. So the major issue we see going forward is policy performance. But other issues contribute also. And one is policy design and complexity. You have a lot of information in today's handbook, and I would suggest that you download that for future reference. But there's a lot of information about the different policy types and managing them. So for today, I just want to very quickly walk you through kind of a permanent life insurance timeline to show the complexity of products. For example, with whole life insurance, if you paid a set premium in all years, the death benefit was guaranteed, which sounds very simple, but it's really not. The premium is fixed, but it can be reduced by dividends or even a loan from the policy's cash value. But if the policy loan feature is not on the policy, you could actually lose a portion of the death benefit if you missed a premium. So while the policy seems simple, there are many moving parts that you need to be aware of, and the policy is not very transparent. That's not so with current assumption universal life. It's totally transparent. You can see where every dollar goes. Unlike whole life, it has flexible premiums, so you can pay as much or as little as you want. But the policy has few guarantees, and as interest rates dropped, many policies lapsed. The industry came up with guaranteed universal life because of those policy lapses. And that took interest rate risk out of policy purchase. The death benefit in a GUL policy was guaranteed as long as the premium was paid in full and on time. But now you lose premium flexibility. And if you're late on a premium or you do not pay the full premium, you compromise the death benefit. Now, with a universal life policy without a death benefit guarantee, all else equal, the higher the rate of return, the less premium you need to carry the policy. So why not invest in equities? And so the industry came up with variable life. Now you could invest in mutual fund clones with you, the policy owner, not the carrier, responsible for making the investment decisions. And by the way, variable life was the first policy where cash value could actually have a negative return. And that was the problem, so the industry came up with a new twist, index universal life, which ties the cash value to an equity index like the S&P 500. The policy has a floor on the credited rates, so you could have no negative returns, like a variable policy, but the policy crediting rates also have a cap that limits the returns that you receive. Now, to add to this complexity, carriers create products that combine features. For example, you can buy an index product with a death benefit guarantee if you pay a required premium. And because long-term care has become a larger issue with your clients, some carriers have added long-term care benefits to their products. So if you're dealing with life insurance, you have to keep up with its evolution. Another thing that's evolving is client expectations. And I'm sure you've heard about the best interest standards. You know, who's a fiduciary and who is not, right? A trustee is always a fiduciary. I happen to be a fiduciary because I'm a CFP and we're held to that standard, but not everyone in the life insurance industry is. So if you are an advisor, you can be held to a higher standard, which I'll talk about in the next slide. But clients certainly expect more from all of us these days because they have a growing awareness. In the TOLI world, I've found that beneficiaries have given up tens to maybe hundreds of thousands of dollars in present interest gifts to fund a policy, get extremely upset when the policy does not work out. I have seen this, and believe me, it can get ugly, which is why we've seen increased litigation and disputes. In the handout, we list the most prominent TOLI cases out there, and you can learn a lot from them by downloading the TOLI handbook that John talked about, because it has a chapter that walks you through each case and the key lessons for each case. But understand something, the vast majority of checks written in the TOLI world are written behind closed doors. You never hear about them, but they are there. For example, a trustee accepts a policy replacement on an agent's recommendation only to find out 2 years later the replacement was bad, the agent's gone, and now the trustee has to write a large check to make the client whole. This actually happened, was one reason the trustee became a client of John's. And now that advisors can be deemed fiduciaries, the liability is spreading. A case a few years ago had a well-known firm and advisor hit with a $14 million payout because the policy expectations at the sale were deemed to be excessive and the policy underperformed. And now, even carriers are being sued. The latest lawsuit is against the largest seller of index products who's been hit with a class action lawsuit alleging the policy they sold was impossible to understand, the marketing was misleading, and the sales illustrations intentionally overstated future performance. Now, I'm speaking to an audience that includes a fair share of attorneys, so you know we live in a litigious society. The world of life insurance, especially trust-owned life insurance, has its share. So now you're saying, wow, Michael, that's a lot of problems. It would be nice if you came up with some good news, and there is good news. There is a solution, or I should say solutions, and that is a prudent process in dealing with life insurance. You know, positive outcomes don't just happen. There's a process around them. You don't become an attorney without a process. An Olympic gold medal winner does not become one simply because he or she wants to be one. There is a process. With life insurance, I have found 6 things have to occur to minimize liability and increase client value. 6 things any advisor, fiduciary, or trustee needs to do. The first is to understand the policy, and that seems simple, right? But do you know what the costs are in the policy? The premium is not the cost. Most trustees utilize a life insurance illustration, and they can be very misleading as we lay out in the handbook. There are a couple of better ways. One is I use Liability, which compares costs within a policy to its peer group. And if you're interested, I'd be glad to share a free report with you to show you its value. But there's another way also, and again, it's free, and that is to ask for the expense pages, which you can request for universal life chassis policies. I reviewed a substantial policy for an attorney trustee a while back, and the base policy was competitive, but the policy had a term rider that was added at the last minute that was wildly expensive. But you could see those costs on the expense pages. By dropping that rider and buying the coverage outside the policy, the trust could save literally millions of dollars, and it was easy to see if you know where to look. I've also listed in the handbook some other steps to take to understand the life insurance policy, understand the policy mechanics, know if there's a death benefit guarantee, and if there is, the requirements to maintain the guarantee, know if the premium's flexible or required. Also know all of the policy caveats and riders. You really need to dig in and understand the policy to manage. Second, memorialize the expectations and possible outcomes. Create a document for the trust file when a policy comes in that deals with things like the rate of return expected and what additional premium might be needed if it's not reached. In other words, after you understand the policy, make sure all appropriate parties do. It might be the single best way I know to mitigate future liability. And don't avoid the grantor responsibilities either. Put them in the document. Again, we have listed all of this in your handbook. It is that important. Something that should go without saying, review the policy annually. Get an in-force ledger and track policy performance against expectations. You need to keep ahead of any issues, which leads to the next item. A month ago, I got a call from an advisor who asked me to do an in-depth review on a policy for an attorney trustee. The insured was in her 80s and the policy matured at age 95. Now, most people think that when a policy matures, the death benefit is paid out. It's kind of a reward for living so long. And that is most often wrong. What you get is the cash value, which is often much less. And in this particular policy, if the insured lived another 10 years, only the cash value would be paid back. And if you think the chances of living 10 more years are minimal, I can introduce you to my in-laws who are both 95 and both in excellent health. But in this case, by looking ahead, we found out in time that the policy would only pay cash value. But we also found out that the policy could get to maturity with no more premium. So the grantor was happy about that. Had we not reviewed the policy with an eye to the future, we would not have found out about either, and there could have been issues with the beneficiaries. Next, communicate often. Keep the client aware of policy performance. Send an annual report. And if the asset is ever adjusted, the death benefit reduced, for example, always make sure the beneficiaries are aware. Next, you need to have the expertise to adjust the policy to changing goals. And that may mean having an in-house life insurance expert or someone you can rely on. Because as John mentioned, this is a long-term asset and things can and do change. The last thing before I go, document all aspects of the management process in the trust file. And why is this important? Well, I'll leave you with this. You cannot always control the outcome, but you can document the process. And if your process is prudent, you will go a long way to mitigating liability and increasing client value. If you have any questions, let us know. Thank you.
Thanks, Michael. It's certainly evident that managing life insurance, especially in the trust environment, is not a responsibility that should be taken lightly. The role of the ILIT trustee is critical, as we know, and I think with that, we're going to ask Tony to join the conversation and provide some additional insight on the various trustee types and how to ensure your client's ILITs succeed. Tony?
Thank you, John. Appreciate it. As a Senior Trust Officer for Life Insurance Trust Company and as a licensed attorney in the state of South Dakota, it's my pleasure to participate in today's presentation. In the time remaining, I would like to discuss the pros and cons of the three most common selections when naming a trustee, and these are a professional, a corporate trustee, or an individual. But first, I would like to just put ILITs into perspective. Especially those that were created between 1990 and 2020. I think most of us would agree that the single largest personal investment for many couples between age 30 and 60 years is often their personal home. The mortgage payment on a $400,000 home, along with the property taxes and homeowners insurance for 30 years, will exceed $1 million. And when you add repairs, maintenance, and upkeep, the number is even greater. By contrast, clients who have an irrevocable life insurance trust will make similar or greater investments between ages 60 and 90 as part of their estate and succession plan. According to ITM 21st Services data collected over 18 years on 50,000 trust-owned policies, the average ILIT will surpass the typical home as the single largest investment for many clients. And you can see in this slide here, it outlines that for you, kind of the total investment on both of those investments. Simply said, your client needs a trustee with experience, someone who welcomes the responsibility of protecting the interests of those with legal standing, the trust beneficiaries. As your clients put great value and pride in purchasing and protecting their home for 30-plus years, they should also understand the importance of protecting their ILIT investment in the same manner. As a trusted advisor, you are in a unique position to counsel, or at the very least, inform them of the importance of selecting the best possible trustee. Considering the following statistics related to insurance trusts. 79% of all insurance trusts are not performing as planned, and little action is being taken to remedy the symptoms. On average, an ILIT is a 35-year instrument and will surely require some fine-tuning and adjustments along the way. 54% of trust-owned life insurance is projected to lapse prior to maturity. Statistics show that advisors and trustees are not doing enough soon enough to adequately protect their clients' investments. 32% of GUL benefits, guaranteed universal life benefits, have been compromised, and in many cases, benefits have been lost without the trustee even knowing. 95% of term trust-owned life insurance is never converted to permanent life insurance, which brings into question what was the original objective of the trust. If 95% of these trusts were created with term insurance because they had short-term needs, then the statistics perfectly align. What is really happening, however, is the client is choosing the cheapest form of insurance, and when originating the trust and failing to adjust or replace the coverage better suited for the long haul. In the final analysis, the statistical data shows that 1/4 of all life insurance policies held in trust will lapse prior to insured's death. So, naming the right trustee for your client's insurance trust is the best way to avoid these issues. These trusts remain a viable tool for estate and tax planning, whether the insurance is being used to fund split dollar, grantor, crummy, or special needs trusts. It is important to name the trustee that can best serve your client's needs. So the first option you have available is an individual trustee. We estimate 75% of ILITs in existence today are represented by individual, non-professional trustees. If you have an opportunity to download our white paper titled Naming Your ILIT Trustee, Did You Make the Easy Decision or the Right Decision? Some of what I will be covering today can be found in this article. The white paper begins by stating the worst decisions we make are for two reasons: simplicity and economics. My colleagues have already made a strong case for debunking the simple and cheap theories, as insurance trusts are in fact complex and require expert oversight and management. The decision to name a friend, a family member, or a business associate may come easy for many grantors, and why not? Who else could look out for us better than a loved one, a dear friend, someone who has shared the business wars with us and won. And of course, the fact that these individuals can serve without costs or great expense make it a no-brainer, right? Since the cost and ease seem to be the primary advantages of naming an individual, would like to just take a moment and talk about some of the disadvantages of naming these people. An individual non-professional trustee may not have the requisite skills or knowledge to manage life insurance. No matter how wonderful a person he or she may be, it is unlikely that they have the capability of dissecting insurance contracts or understanding how to analyze policy illustrations. Number two, they may not have the time to properly administer the trust, even if they understand all that is required of them. Number three, they would likely lack proven procedures and perhaps the ability to make prudent decisions related to the trust and policies. These are decisions that must stand the test of time. For example, are there memorialized notes and analysis to support his or her decisions? Do they have the wherewithal to manage policy loans, policy dividends, policy conversions, policy guarantees, policy options and riders? Will they know when and how to challenge the insurance carrier regarding underwriting, premiums, and are they capable of managing variable policy asset allocations? Number four, do they have the wherewithal to understand and interpret the trust document? As an attorney and trust officer who has reviewed hundreds of insurance trust documents, I know how difficult this can be. Number five, when things get dicey, will the trustee remain unbiased towards the beneficiaries? Is it fair to put this person in a no-win situation should family squabbles arise? Number six, as Judith explained earlier, is this person aware and comfortable with the liability associated with becoming a trustee? While a non-professional trustee is not held to the same standard as professionals or corporate trustees, they can still be sued and be on the hook for any policy mismanagement. And number seven, humans are not immortal, and individual trustees may not survive the trust. Who takes care of the trust if this happens? Are the books and records organized? Does the successor trustee have what they need to carry on? Even if your client opts for the simple and economic advantage of a non-professional individual trustee, it may prove worthwhile to have a discussion of the 7 items outlined above in the interest of full disclosure. The second option is a professional trustee. We believe this represents approximately 15% of all trust-owned life insurance, and it is often an attorney, CPA, family office, or financial or life insurance advisor with professional designations such as a CFP or CLU. This option may be more beneficial than naming a friend or relative, so let's review the advantages and disadvantages. So some of the advantages: a professional is more likely to understand their fiduciary duty to the client. He or she is likely familiar with the client, knows the family, understands the goals and objectives of the trust. More likely to engage outside experts to assist in fulfilling administrative and asset management responsibilities. So those are some of the advantages. Let's look at some of the disadvantages. Professionals who agree to serve as trustee may find the may find that accommodation a distraction or drag on their core business. Just because a trustee is a professional doesn't mean they have the systems or procedures to adequately administer and manage the trust or the policies. They may not have adequate liability protection to cover trustee mishaps, as Judith explained earlier. Depending on who the professional trustee is and what type of relationship they have with the client, there may be conflicts of interest. For example, if you are the attorney who drafted the trust for the grantor, can you also serve as trustee and protect the interest of the beneficiaries? You have a legal obligation to the grantors as well as the beneficiaries once you become trustee, and we know that these interests may not always perfectly align. If the trustee happens to be the agent, broker, or even CPA or attorney and receive commissions or compensation, there could be issues with conflicts of interest as well. The final one is the corporate trustee. Since 1990, the use of bank or trust company trustees has declined from an estimated 35% at its high to approximately 10% today. During the 1980s and 90s, naming the local bank as trustee was common. That trend radically changed the past 20 years as we've seen a 50% reduction in the number of ILITs accounts held by corporate trustees. The perception by bankers for years was that the ILIT would be a great loss leader. They would provide future assets to manage, would keep the customer tight with the bank, and of course there would be other products or services to offer. In fact, the opposite has occurred. Beneficiaries began suing trustees for breach of fiduciary duty. Trustees failed to properly understand and manage the complexities of an evolving array of insurance products, and many were unable to scale operations. So let's look at the pros and cons of a corporate trustee. Some of the pros: continuity. Knowing the trustee is an institution and not an individual may provide peace of mind, avoids the concern of your client living longer than the trustee. Licensed, regulated, and audited by regulatory agencies. Provides peace of mind that the trustee is being held to a higher standard than unregulated individual trustees. Third is professional standards of accountability as evidenced in the OCC's unique and hard-to-value asset manual. And number four, corporate trustees tend to carry large insurance policies in case there ever is an issue. Recovery is much more of an option. Some of the cons. Many institutions now provide a wide array of financial services, including insurance, sales, investment, and asset management services. Advisors are increasingly protecting their clients from competing interests. Trustee fees may be high and not practical at some times. The trust approval and account opening process can be a little bit tedious and lengthy at times. So that's some of the pros and cons of a corporate trustee. Some final thoughts here. Having worked with all types of trusts, I can honestly make an argument for and against each of the choices, which is why it is important that the advisors who guide the clients are informed and able to help the client make the best decision. Helping clients select the right trustee will reflect positively not on you and ensure the best possible outcome 30 to 40 years from now. Key characteristics and capabilities of an ILIT trustee include the following: expertise, commitment, and desire to serve as trustee, ability to onboard ILITs, trust administration, ability to manage these policies, remediation, taking action if any action is needed on these policies, and customer service. So whether our clients become old and forgetful, can't afford to continue paying large annual premiums, or if they don't believe they have estate or tax liabilities, their insurance trust desperately needs someone with expertise, with expert oversight and management. When the family home is no longer needed, they simply don't walk away. They sell it and downsize to something more conducive in their retirement years. Yet when it comes to insurance, far too many clients are willing to walk away with little or no consideration for the investments they have made. Few trustees understand their fiduciary duty and expose themselves by not properly representing the interests of the trust beneficiaries.
Thanks, Tony. Some great points as it relates to the critical trustee selection process, for sure. As you mentioned, there's advantages and disadvantages of each option, and really highlights the importance of the wealth advisor's role to ensure long-term client success. And so with that, we'll wrap things up. Again, we want to thank everybody for attending this Trust and Estate CLE webinar today. As we've mentioned numerous times, the session handbook is available for download, and please take advantage of the additional free resources that were mentioned over the last hour, some of which you can see on the screen here. At this time, we're happy to answer any questions that have been asked, so I'll turn it back over to Susan to lead that portion.
All right, well, thanks. And there have been a number of questions, so let's get started. With the Secure Act taking away non-spouse IRA stretch, would an ILIT be a good fit to act as a substitute?
This is Michael Bro, and I'm going to hop in and say, yeah, a lot of people, you'll see a lot of articles out there in the marketplace talking about the fact that the availability of a tax-free, totally tax-free estate and income tax-free asset to take to add to the estate of someone who has a retirement plan, qualified plan that might be subject to additional taxation is something that is happening in the marketplace right now.
Anybody else want to chime in before I go to the next question? Okay. How is the IRS final regulations on new reporting requirements for life insurance contracts impacting life insurance owned by trusts?
I'm not 100% sure what the questioner is referring to exactly, but I'm going to say that if it refers to either life settlements or life insurance on the carrier level, there is no effect that I've seen on the trust-owned life insurance world. I don't know if anyone else has anything to address. If that doesn't answer the question, then our email addresses are in the handbook, and that person can reach out directly, and I can try to get more detail.
Okay. All right. And the next question is, I'm interested in the advisability of moving existing high cash value policies into an ILIT to allow access to the cash value during the life of the grantor and transfer of the policies to the beneficiaries upon the death of the grantor. Not interested in funding a policy with trust assets, but as a holding vehicle. Your thoughts?
Anybody else want to jump in, or you want me to? Okay, this is Michael Broad. I'll jump in with two things. First of all, the reason why we put life insurance in a trust is because we have estate taxes due. There's other reasons too, but essentially it's because there's estate taxes due. People typically don't put high cash value life insurance into life insurance trusts in general. I don't know the other particulars around this case, what the estate tax ramifications are, et cetera, so I can't really opine on the exact situation. There certainly are situations where if the trust is written so that you can get access to that cash value to the spouse or to beneficiaries, there might be some value to that. But unless there's a real estate tax issue, I don't see that there's a lot of value in that.
Yeah. This is Tony. I would just add to that one thing you're going to want to be very, very careful of if the trust allows any type of income to be distributed or any of the assets back to the grantor or the spouse of the grantor's estate tax inclusion. So I agree with Mike that these typically aren't used as a tool to provide for the grantors later on in life.
Okay, let's go to the next question. Are there elevated risks for the insured spouse to serve as trustee?
So I'll leave that to you, Tony.
Yeah, I could certainly answer that. I don't know if there would be, necessarily elevated risk for the grantor's spouse to serve as trustee. I mean, you want to. I think I outlined some of the advantages and disadvantages of naming an individual as a trustee. Certainly as a family member, one of the things that we want to be very careful of is that there's as much distance from the grantor and the trustee as possible so that you're not, the grantor is an irrevocable trust, so we need to make sure the grantor is staying out of that to the extent that they can. So I don't see any added necessarily liability other than the liability of naming anybody as an individual.
All right, I think we have time for one more. Does shorter duration perm policies make sense for TOLI, for example, a 10-pay? And do you see a lot of premium financing being done with ILITs?
Yeah, let me jump in and talk about the first part of that. The funding of the policy is really dependent on the client's particular situation. I do know that I've seen a lot of law firms where, one law firm in particular, where I've done a lot of reviews where clients that had a liquidity event, someone sold their business for 10, 15, 20, 30, $100 million, and they were setting up an ILIT, they would buy a guaranteed universal life policy with a short pay, a 7 or 10 or 5 year premium, so that they just were done with it. It's guaranteed, it's in the trust, we don't have to worry about it. There's no advantage or disadvantage to short pay versus long pay because it's in a trust necessarily, but we do see that happening. And to the second part about premium financing, and Tony, you could probably speak to it better than I can because you're more involved in the trust coming in. But certainly premium financing today with this low interest rate environment that we're in, one of the advantages of the low interest rate environment is interfamily and intergenerational loans. So premium financing is advantageous for that reason. I don't know if you're seeing more or less of them, Tony.
Yeah, no, I think premium finance probably represents, less than 2 or 3% of our overall portfolio. We do see it. It's more of a complex plan. There's a few more moving parts in it. So I think, like Mike said, it really has to come down to a more family situation as to whether it makes sense or not.
All right, well, unfortunately, we've run out of time, but the speakers will get your questions if they weren't answered already, and they can get back to you at some point after the presentation. So again, I'd like to thank Life Insurance Trust Company for sponsoring this webinar, and of course, all the speakers for their outstanding presentation. As a reminder, you'll receive a follow-up email that will include a link to view a recording of today's presentation. If you found this event useful, please encourage your colleagues to register and subscribe at our special introductory rate so they can also enjoy exclusive programs like this one live. Once you leave the event, a short survey will pop up in your browser window. We'd appreciate it if you would share your feedback on this event, as it helps us to provide you with content most interesting for you. And of course, the people who are seeking CLE credit, please make sure to put in that code word that I mentioned earlier. On behalf of Trust and Estates, have a great remainder of the day.